Hi there, you're watching Forecast. Today I have BNP Paribas' Michael Schneid on the line to have a look at the dollar yen. Now, Japanese stocks climbed up to a 7.5-year high today as a downward revision in third quarter GDP figures was offset by the weak yen and optimism over the US economy after it had strong jobs data. Now, Michael, how do we expect the dollar yen to trade over the next month?
Well, so far, the development in the fundamentals for dollar yen has been very supportive. We've had the new easing from the Bank of Japan. We've had Japanese growth disappointing, and we've had US growth coming in stronger than expected. Now, I think also what's very key for dollar yen is that when the Bank of Japan eased policy, there was very little positioning in dollar yen. So that is, investors didn't really have the trade on. And what we've seen over the last 6 weeks or so is investors very aggressively entering long dollar yen positions. And actually now, going into the end of the year, positioning is starting to look a little bit vulnerable. So underlying fundamentals are very supportive. We think of dollar yen moving higher, but we're very cautious about recommending getting into long dollar yen positions at these levels. Short term, over the next couple of weeks, we could see a bit of a squeeze lower in dollar yen, but ultimately our medium-term view remains quite bullish.
How will the Fed's decisions impact the dollar yen over the next 6 months?
We think that the Fed's decisions are very key for dollar yen. But we at BNP Paribas think that the Fed is going to be one of the first major central banks to be hiking rates, and we expect this to be before the market is currently pricing. So we're looking for the first rate hike to be delivered around June next year. Now, the improving economy in Japan is very key to this, but also what's very important is we expect the Fed to look through the impact of the lower oil price. So currently, although the oil price is likely to be weighing on US inflation, we expect the Fed to be focusing on lower oil being a boost to the US economy. And this feeds very much into our hawkish outlook for the Fed. So we're looking at the meeting in December for the Fed to be removing its forward guidance and really preparing the market for a lift-off in rates in mid-2015. This should help keep US yields supported, and that will feed through to keeping dollar yen supported.
And Michael, finally, you believe the dollar will reach 128 against the yen by the end of 2015. Now, what other sort of driving factors are you expecting to see?
Yeah, the bottom line here is that by the end of next year, we think that the yen is going to be substantially weaker from current levels. So although we've seen a lot of yen weakness this year, we think there is more to come. Not only is there the US Fed hiking cycle that we spoke about, but also we think next year we're going to see increased fiscal uncertainty in Japan. And the story here is basically we've seen Abenomics deliver the first two arrows, that is looser fiscal policy and looser monetary policy, but we've yet to see the third arrow be delivered, structural reforms. And without these structural reforms, we think the market is going to be getting increasingly concerned about the future for Japan's debt. The situation is that with Japan's debt approaching 200% of GDP and inflation starting to rise, this starts to put concerns about whether the debt outlook for Japan is sustainable. And we think ultimately in this scenario of higher fiscal uncertainty, it's really the yen that is going to be the variable that suffers. So this will help keep dollar yen supported throughout next year.
Michael, thank you very much for your time. Well, viewers, do not go anywhere as we have plenty more heading your way on Dukascopy TV today. See you very soon.